Hello, everyone. I'm your host, Andrew Johnson, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to make you, our listeners, more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in be boring, make money.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
All right, playing the plan, global small cap, and we have Karan Vadka joining us today, co-manager for the portfolio. Karan, let's jump right in. 2022 has been, well, it's been quite something, and that's following several years now of seemingly heightened uncertainty, whether it's been the pandemic, inflation story, interest rates, geopolitical turmoil, and then, of course, all of the volatility that brings to the stock market itself. Our listeners, I think, have a pretty good grasp of the broad strokes of what's happening out there. So I'll kick things off more in the direction of what we can do about it and how we can deal with all of this uncertainty. And as you know, we often talk about preparing and not predicting. So what does that mean to you? And what are some of the practical ways that help you and the team prepare the portfolio for multiple scenarios?
Hey, Andrew. Yeah, so that's a good question. I think to me, it means building a resilient portfolio that can preserve and grow client capital in the fullness of time and across a wide range of scenarios. Sometimes the weather forecast might look stormy. People think there's a chance of rain. But instead of staying indoors all day in fear or going out in a swimsuit, for example, an easy thing to do is just carry an umbrella. So in more practical terms, from an investment standpoint, it's really about having contradictions in the portfolio and staying balanced. So what does that mean? A couple examples would be being globally diversified, keeping the fund liquid, owning companies that fit the philosophy across sectors and in all parts of the quality return spectrum, or the matrix as we call it here at Mawer. So none of these individually rely on predicting the direction of interest rates or geopolitical conflicts, for example. They're all pretty sensible things to do in most scenarios. So to be robust, you really have to avoid any sharp concentrations in any single dimension, because that's what stops all the compounding from happening if you go back to zero. So again, the key to emphasize here is that resilience doesn't mean that the portfolio will outperform in every scenario, but rather that it can survive any scenario. And that gives you time for the odds to land in your favor.
Good overview. I'm assuming here that being a global portfolio, that's helpful in this context because you may have more stones to turn over, maybe more places to allocate capital. How does all of that factor in?
Yes, so being global definitely helps because, as you alluded to, it just gives you more options. And a big part about playing defense is actually having options and not getting stuck with the existing positions you're in because you have somewhere else to go to. Another rock to turn over, I guess. Being global, not only from a diversification standpoint is helpful on the defense side, but even on the offensive side, it just gives you more opportunities to make money.
One observation that some clients have made and others throughout this most recent period is that small caps in general have performed worse than large caps. Can you talk about why small caps perform differently and the role that maybe they play in a larger diversified long-term portfolio?
Yes, I'd lead on an analogy that my colleague Christian uses about risk and liquidity. So if you take a moment and just imagine sort of an island, a nice sunny island in the middle of the ocean with a big mountain in the middle, and think slowly of just the tide rising. In your mind's eye, you can sort of see the water starting to flood the shores, maybe the beach houses next, and then slowly move up the mountain. So I think you can think about risk and money flowing into or out of asset classes in the same fashion. So at the top of the mountain, that's sort of the safest, or what people perceive to be the safest at least. And that would be maybe US treasuries or perhaps blue chip large caps. So people feel safe in these. The waves of fear don't hit this part of the island first. On the other end, right at the shore, is maybe micro caps in emerging markets. And that's where investors only go when they're feeling really brave. So in that context, you could hypothesize that small caps are lower down on that island. They feel more of the pain and they feel it earlier when appetite for risk dries up. As to small caps versus large caps, I don't have a strong view on which one outperforms because really it depends on the starting and ending point you pick. But at the end of the day, I would say that small caps do zig and zag a little bit differently to large caps. And there is also more potential to find a big difference between the winners and losers. So dispersion, I believe, is the term for it. And that can create a lot of value when you add it into a broader allocation.
What are some of the specific factors that may provide those different ways that a small cap would zig and zag versus a large cap?
Yeah, so the way to think about it is that a large cap, typically, just given their scale, they're a bit more diversified across the economy. So maybe they aren't as affected by idiosyncratic factors and they more flow with whatever the industry or the end market is doing, just because they are kind of the end market in a way. Whereas a small cap, again, much smaller, and management might have more influence over moving the ship. It's more like a nimble little life craft as opposed to a tanker. So again, they may feel the effects of the broader end market even more severely, or they may feel it much less because they have a lot of opportunity to take market share, control their own destiny. So again, not only from a liquidity standpoint would they move differently, but also from a fundamental standpoint, they can move quite differently sometimes to what the end market is doing.
And I assume small caps, generally speaking, just have less eyes on them as well. So there's perhaps more of an opportunity to find pricing discrepancies with them.
That would be the hypothesis, yes, but I think it varies a lot again by country. So in the US, you may have a lot of people looking at small caps, for example, whereas in another part of the world, you may have less people looking at it. At the end of the day, though, the first filters we use is just the philosophy. So is it a wealth creating business run by an excellent management team? And then that final piece, a discount to intrinsic value, that will be a gauge to measure whether there's a lot of people looking at it or not.
Just to shift gears slightly and look at our portfolio specifically, it has been behind the benchmark. And I guess a lot of clients are asking, is there anything specific that you see as a portfolio manager to tell you why our holdings may not be performing in line or better than the market more recently?
Yeah, you're right, Andrew. So performance on a relative basis especially has not been impressive. And clients may also be surprised to find that their fund hasn't held up as well in a period of weakness relative to the past where it has been more defensive. So it's not always easy to pinpoint exactly why we're sort of performing differently to an index. I think it's fair to say that our investment style has been somewhat less popular of late. So that's definitely a contributing factor. Generally speaking, if you look at all the funds out there that perhaps own higher quality stocks that sometimes come with a higher rating or multiple, they've faced more headwinds than usual. I think COVID introduced a lot of uncertainty and the market continues to grapple with this. And when things are most uncertain, we all have a tendency to herd from one safe place to the next just to avoid the pain. And we've seen this a lot with the market seeming to swing from one topic du jour to the next. So whether that was cyclicals right after the vaccine announcement to commodities more recently on inflation fears. That being said, I think some of these basic economic principles in our investment philosophy should bear fruit over time, and we've been pretty reluctant to chase the next hot theme. That context or that backdrop being said, it is fair to say that in hindsight, we could have been just quicker to trim on the more expensive names in the fund. So while we had been bringing down the average multiple of the portfolio for over 3 years now, so this is something that we've been doing for a while, not just recently, it really wasn't fast enough. And partly because every time in the past we trimmed an expensive name, it just got more expensive. So behaviorally, it was quite painful to follow through on. So while we've sharpened our pencil with regards to just valuation discipline, I think it's important to also talk about some of the things that haven't changed. So the most important one is just cultivating a culture with high levels of trust and candor, an investment philosophy that makes economic sense over time, and then continued execution of a repeatable investment process. So I'm pretty optimistic about the fund over the next 5 years. My story is that the portfolio has lots of companies that generate superior returns on capital, run by excellent, often owner-run management teams, and that now trade at an average multiple that's in line with the market, despite being better quality in our view. In our view, again, that sort of setup is akin to sort of what we're always looking for, which is a bargain.
You mentioned that trimming some of those more expensive names was behaviorally difficult to deal with. And then you also mentioned continuing investment into culture and building trust. Can you expand on all of that and how you and the team recognize and deal with the behavioral aspects of portfolio management?
Yeah, so I think the behavioral aspects are often overlooked. At the end of the day, whether you're following a more quantitative approach or even a more discretionary one like ours, it's people that are making the decisions. So people are deciding what data goes into it. People are deciding what evidence to overweight or underweight, and people are deciding what to do about that. And as soon as you involve people, you involve emotions. So that's a big part of why we have a process. It's to really be, number one, aware of the emotions that we're feeling. And then number two, try to reduce that bias and get to sort of the correct or more correct answer so that over time, the odds are in our favor. So as you alluded to, there's sort of these economic principles of, look, it's not just about having a good business, it's about having a good price. And that's what makes a good investment. And while we're sort of aware of that, and we've definitely kept that back in mind, the other side of it is that the market was rewarding stocks that were expensive and they would keep going up more. So you have to balance those two. On the one hand, there's like an economic truth that's evident, but that can be over a 5, 10, 20-year period. And on the other hand, you're getting instant feedback from the market on whether you've been right or wrong. And that's really where the culture comes in. And that's where having experience from different teammates is helpful too. So Christian, as an example, the lead manager, he's been in this market for 20 plus years. So he's seen this go around before. And having that oversight was really helpful because it pulls you back and say, hey, this has happened before. Let's not get carried away. So again, I think it is something we were aware of, something that we were doing. So we were actively switching into names that were cheaper. But again, in hindsight, it's easy to say that you could have done it quicker.
Thanks for that. And I just want to keep building on this topic of performance, generally speaking. When you reflect on things in the most recent period, has there been anything that has surprised you, either negatively or positively within the portfolio so far this year?
Yeah, I think the one area where I continue to be surprised with is just businesses that sell scarce skills. So I think Warren Buffett in a recent interview said that the best hedge against inflation is having a skill set that people want and need. Maybe the second best way to do that is to own shares in companies that provide this sort of skill set. So many of the service providers we own, whether that's accounting firm CBIZ or payroll service provider Insperity, or even some IT consultants, they've done really well in a tight labor market by selling skills to customers that need them. The immediate response or first level thinking might be that, hey, if you have a lot of labor in your cost base, then inflation is bad and your margins will get squeezed. And that's true, unless you're actually directly selling the labor or the talent. In that case, you actually benefit from some nice pricing power because you control a scarce resource or skill set that customers want.
Can you talk a little bit more? You mentioned two of those names. So I think it was CBIZ and Insperity. Talk more about specifically what their businesses do and give a little bit more color on how they may be doing well in this environment, as you just alluded to.
Yeah, so CBIZ, pretty straightforward. The bulk of their business is audit and tax services for mid-market businesses. So for example, if you're Mawer, let's say, or if you're some other small mid-market company in the Midwest in the US, typically you're going to need an accountant to file all your taxes, to audit your financial statements. And you could go with the big four, but they can be pretty expensive. They may not have a lot of in-person feel or strong relationships in your smaller town. So perhaps you won't choose them. Or you could go with a mom and pop accounting provider, but they just won't have the scale or necessarily the expertise to pull from all around the country to do some of your work. So that's where CBIZ fits in. They're a mid-market player. They sit in the middle of those. And really, they're providing a mission-critical service. So you have to do your taxes or you get in a lot of trouble. You have to get your financial statements audited. And there's just no ways about it. So having that skill set and those relationships really helps them deliver value for clients and then price for it so that they get their fair share too. So that's CBIZ. Insperity. So this is also a US company. It's a little bit unique. One of the unique aspects of the US is that the healthcare system is pretty tricky to navigate, especially if you're a smaller business, an employer, and you have to do payroll. You also have to figure out health insurance and just all of the administrative stuff that goes along with that. It's just a big headache. Wouldn't it be easier if you could just outsource that and just pay a service provider sort of a fixed fee per month that you negotiate on, and then you still have the employee, you still do everything you need to, but all of that headache is with someone else. So that's what Insperity does. They're an outsourced services provider doing payroll, health insurance, things of that nature. And again, they're providing sort of the administrative skill set, both in terms of people as well as technology, to make the lives of small business owners a lot easier. And they've been benefiting too in this period because, again, it's something that employers particularly want in a tight labor market. And it's a skill set that, frankly, they don't want to have to do themselves. They'd rather use someone else. So that would be Insperity.
Both great examples of trying to find a scarce resource that's in high demand. And obviously, there's more to it in terms of finding a good management team to run those types of businesses as well. I just want to shift gears over into more of a portfolio construction conversation. And one other observation when looking at the portfolio from a top-down perspective, at least, is that there's an overweight to stocks in Europe versus the US, for example. And one of the questions and discussions that comes up in client meetings or even internal meetings with us is that just giving the more challenging situation that Europe appears to be in, whether that's higher inflation than here or gas prices that are staying higher, those may hurt consumers more than in the US. What's your take on the strength of the end markets of our European holdings?
You're right. So we do own more in Europe relative to the index and less in the US. And it does certainly seem that the dominance of the US economy, particularly on relative terms, has continued. It's definitely a portfolio exposure that we do think of. On the other hand, it's important to note that as investors, as owners, we're not buying Europe. We're not buying the US. We're buying companies that might be located in those regions. Some might say that's just semantics, but it is an important distinction. I think individual companies, they could be headquartered in a specific country, but they sell globally. Or they may sell to a specific end market within a country that's essential and can't be avoided, whether or not there's a severe macroeconomic shock. So as an example, we own RS Group. So this is a UK listed distributor of hard to find electrical and industrial components. 2/3 of their business sits in Europe, but despite this, they continue to grow their economic profits quite strongly. So you might be wondering, why is that? Well, because they help clients find small items like a resistor, let's say, or a display, or perhaps even a surge protector that they urgently need when something in their factory breaks, as an example. So their average ticket is less than $100, and it can be delivered in under 24 hours when the customer needs it most. So this sort of criticality and convenience ensures that market leaders like RS, they'll find ways to make money because they're doing something really valuable for their end customer, even if the broader economic backdrop is weak. So again, you're right that, the end markets in Europe probably are facing more headwinds, it seems like today, than other parts of the world. But at the end of the day, it really does come down to sort of the business model itself, how important it is, how much value it adds to the customer, and then the management team and the actions that they take. And that, in our view, over the long run, will swamp some of these macroeconomic shocks.
Yeah, that certainly strikes me as a great example of the type of business that we're looking to hold for the long term and benefit from that compounding over a long time period. And it's also a good segue into the last topic that I wanted to touch on, which is security selection in particular, and how you're preparing the portfolio moving forward. You've mentioned CBIZ, we've talked about Insperity, you just talked about RS Group. Are there any other holdings that come to mind that can illustrate the types of businesses that we're looking for out there in the global small cap universe?
Yeah, maybe another fun one to chat about here is a more recent addition over the past year. It's a company by the name of Synsam. So I may make some puns here because it's an eyewear retailer based in Sweden, so you'll have to bear with me. So at its face, it's a pretty straightforward business. Eyewear retail, so glasses, sunglasses, contacts. And in our experience, this business model does pretty well around the world because there are some regulations around who can test and prescribe glasses, which means that companies need the financial standing to attract and train highly paid optometrists. And there's also a medical element here. So it creates a book of customers, which forms sort of repeat relationships, something that's often lacking in just general retail. So again, the business model benefits from stable demand people need to see through thick and thin, and the base rate is pretty good just for the business model. I think Synsam is interesting because it takes it a step further, since half their business comes from a subscription plan where the customer can mix and match 3 or more different glasses and sunglasses and just pay monthly with the option to swap out a pair every year. So customers seem to find this great value, and the company benefits from more revenue that's very high visibility. No pun intended. Synsam, they're already the market leader, but with this program, they're growing their share even further because it is actually pretty tricky to build a subscription service. It's harder than it looks. So the current management team, they're the architects of the concept, and they're also shareholders alongside us, which we quite like, the alignment. And the valuation, in our view, looks pretty attractive because it trades at or below market multiple and could generate double-digit IRRs looking ahead. So overall, it fits nicely into the portfolio. It's a resilient business. It has good upside, and it's not a direct bet on what commodities are going to do or what Putin is going to do with Russia and Ukraine. It's a pretty resilient business. People continue to need this. They're a market leader. They do something unique and scarce, and they're run by an aligned management team trading at a discount to intrinsic value. So that's Cinta.
Excellent. Yeah, that's a great example of also focusing on what we can control, which is sticking to our philosophy, as you just outlined, understanding the fundamentals of the business and finding a long-term spot for it in the portfolio. And obviously keeping an eye on it as we move forward, no pun intended. It's also a great place to wrap things up. As always, Curran, thanks for joining us. We really appreciate your time.
Great. I enjoyed the chat.
Hey everyone, Andrew here again. To subscribe to the Art of Boring podcast, go to mawer.com. That's mawer.com/podcast or wherever you download your podcasts. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Thanks for listening.